Hi, if this video has helped you in any way, kindly take a second to show your support to what we are doing for you. Be part of the growing Accounting Made Simple family. Click subscribe, like, share, and comment and hit that notification bell so you're always first to know when new content drops.
Hello students. My name is N Muchai, your Accounting Made Simple tutor. Once again, like we have always asked you, and you've been really supportive to us, we want to urge you, if what we are doing is adding value to you, kindly like, share, subscribe, hit the notification bell, comment, and tell us how we are doing. Tell us how we are doing. Thank you very much. Today we want us to solve a depreciation question, an ATD1 November 2015 question 1. ATD1 Financial Accounting November 2015 question 1. And the question reads, Ben Omoiga started a transport business on 1st of January 2012, operating under the name Safari Services. He bought motor vehicles as follows. 2012, on 1st January, he purchased a motor vehicle KBM 4413G at 1.2 million. On 1st of July, he bought a motor vehicle KBM 6291K at 800,000. The following year, 2013, on 1st of April, he bought that motor vehicle KBP 1540F at shillings 900,000. On 30th of September, he bought a fourth motor vehicle KBQ 1940X at shillings 1 million. 2014, 30th of April, KBM 4413G was disposed for shillings 900,000. On 30th of June, KBM 6291K was involved in an accident and was written off. The insurance company paid a compensation of shillings 680,000. On 31st March, KBP 1540F was traded in with KCA 9450, which was valued at 1.2 million. Ben Omoiga paid the dealer 400,000 shillings in cash. Depreciation on a motor vehicle is to be provided at the rate of 15% per annum on the straight line method on the pro rata basis. Require the motor vehicles account provision for depreciation and motor vehicles disposal account. My word for our accounting students. Be very careful when you find these two things, this kind of a question with the two things. Number one, the dates, the transaction dates. Number two, be very careful with the description of the vehicles. You must capture the account and the description of the vehicle, because the disposal or acquisition and the relevant depreciation computing will depend on your accuracy of doing this thing. So quickly, we prepare the motor vehicle account very fast. So if I was to say motor vehicles account, and you always start with the motor vehicles account, we're told on 1st of January 2012, the year is 2012, 1st of January, we are saying we bought through bank. Always say bank. Then you describe the vehicle inside through brackets. KBM 4413, KBM 4413G. You bracket it. 1,200. Here you're saying in shillings in thousands. And on 1st of July, we're saying we are buying the whole bank, and we're saying we are buying KBM 6291. KBM 6291K, and we are buying it at 800,000. That's what those were the only transactions of 2012. So we add the two. This is 2 million. So 31st of December, the year is 2012. We say balance carried down, it is 2,000. And then whatever we carry down is what we bring down. So we say 1st of January. So here we say the year is 2013, 1st of January. We say balance brought down is 2,000. Balance brought down is how much? 2,000. But in 2013, on 1st of April, we buy through bank. We buy through what? We buy through bank a vehicle called KBP 1540F. KBP 1540F. KBP 1540F, and we are buying it for 900,000 on 1st of April. And on that year of September, we are buying through bank, a vehicle KBQ 1940X. KBQ 1940X. KBQ 1940X, and we are buying it for 1,000 shillings. Giving us a total value. We never disposed anything in 2013, so our total value becomes 2,900. And 2013, 31st of December, we do computation at the end of the year, but that's of December, we say balance carried down is 2,900. 2,900. And we bring it down in 2014, and you're saying 1st of January, balance brought down is 2,900. But on 20, something happened. On 30th of April, 2014, we are disposed of. So we are taking it to motor vehicle disposal account. So we are taking it to motor vehicle disposal account, and you are taking 9. Now please. Here I'm moving a bit slowly. We are told on 30th of April, KBM 4413G was disposed for 900,000. 900,000 is the money we are receiving. It is not the amount we are removing from the motor vehicles account. From the motor vehicles account, we remove the original purchase cost of the asset. The original purchase cost of the asset is what we paid when we were buying. It is not what we are receiving when we are selling. So we remove what we paid when we bought. We remove what we paid when we bought. So that's why I was saying the description of the vehicle is very, very important. We say this is KBM 4413G. 4413G. Now, if you look, KBM 4413G is this vehicle. KBM 4413G, it is this vehicle. How much do we buy it? Although we are receiving 900,000 for this vehicle, we bought it at 1.2. But we are receiving 900,000. So it is not the 900,000 we record here. It is the amount we bought. We are removing the vehicle from the motor vehicles account, and we are taking it to the market I call the motor vehicle disposal account. We are removing it, the original purchase cost, we are removing it from the asset account to the disposal account. So we look for it. When did we buy it, and how much did we buy it at? So we bought it at 1,200. So we are removing 1,200. Although we are receiving 900,000, we are not removing 900,000. We are removing the original purchase cost. And I want to put it here. Motor vehicle disposal account. Disposal account. Remember, this is 1 year. This activity, the disposals are taking place in 1 year. So you can actually take all the disposals in that one account. If they were taking place in different years, you would have the motor vehicle disposal accounts for those different years. So we bring it here, 1,200, and we are saying it is coming from motor vehicles account. And we are saying the date is 30th of April 2014. 30th of April. Then the same thing we are told on 30th of June, we are disposing through motor vehicle disposal account. Disposal account. We are taking to the motor vehicle disposal account a vehicle called KBM 6291. KBM 6291K. Once again, we are receiving 680,000 for this vehicle. But what we are not recording 680,000, the amount we received. We will trace it back when we bought it, and we remove the original purchase cost. We look for KBM 6291 and you find it is this one here. So we are removing 800,000, although we are receiving 680. We are removing the original purchase cost. So we look for the original purchase. These principles are very, very important. They help you never to be confused by depreciation accounting. When you are selling, we remove the original purchase cost. So you look back into your asset account and you find out how much you are removing. You are removing what we bought. So we are removing 800 and we are taking it to the asset disposal account, 800,000, and we are saying it is coming from motor vehicles account. It is coming from motor vehicles account, and we could even have done it on 30th of June or that at the end of the year. That 30th of June. 30th of June. Now, then we are told something very interesting. On 31st, trade-in accounting. Trade-in accounting. It's very, very important that we understand it. We are told on 31st March, KBP 1540 was traded in. KBP 1540. We are selling this vehicle. We are disposing it. And therefore, we remove the original purchase cost. So we do the same here, but it's, that 31st of March, and we are saying we are taking it to motor vehicle disposal account. My space is small, so bear with me. My motor vehicle disposal account, and we're taking KBP 1540. KBP 1540. Once again, we are although we are getting a value of 800,000, we are not recording 800,000. We are recording the original purchase cost, 1540F, KBP 1540F, KBP 1540F. We are removing the original purchase cost. We are not writing here the money we are receiving or the value we are receiving. We are removing the original purchase cost. We are removing 900. We bought it at 900, so we remove it. We come here and we say motor vehicles account. Motor vehicles account. We are KBP 1540F. KBP 1540F. KBP 1540F 900. This other one was KBM. This 6291K. 6291K. This is KBM 4413G. 4413G. Very, very important, you capture the description of the asset. Now, we are told this way that it was traded in for KCA. We are receiving another vehicle on 31st of March. On 31st of March, we are receiving another vehicle, partly through bank and partly through motor vehicle disposal account. Motor vehicle disposal account. Please, this vehicle, partly we are paying some of the money, and partly our old vehicle is helping us reduce the value. We are told that the value of this vehicle is 1.2 million, but we are only paying 400,000. We, the owners of the vehicles, although this vehicle is, we are receiving a vehicle worth 1.2 million, we are told we are only paying 400,000. So the bank, we pay 400,000, and then from motor vehicle disposal account, we are receiving a value of 800,000. So what are we saying? We are saying we credit bank and we debit the motor vehicle account with 400,000. Then we debit the motor vehicle account with 800,000, and we credit disposal account. We come here, we say motor vehicles account. Motor vehicles account, we credit it with 800,000. With 800,000. We credit it with 800,000. We credit it with 800,000. So we are receiving a motor vehicle worth 1.2 million, but we are only paying 400,000. 800,000 is being paid by the value of the vehicle we have traded in. Now here, instead of receiving money when we are selling the scrap value of this vehicle, we should have debited the bank and credited motor vehicle disposal account. But instead of debiting bank, we have debited motor vehicle because we are not increasing the asset of bank, we are increasing the asset of motor vehicle. So we debit motor vehicle with 800 and we credit the disposal with 800. And that finishes our motor vehicles account. That finishes everything about our motor vehicles account, and we close it off, and we are getting the first answer now. 2,900 plus 1,200, we get a figure of 4,100. 4,001 what? 100. So we subtract the disposals, minus 1,200, minus 800, minus 900. Our closing value is 1,200. 1,200. That the 1st of December, we say balance carry down. That's the way to do the motor vehicles account. That's the way to do the motor vehicles account. Whatever we are disposing, we have taken to the disposal account. We have taken to the disposal account. I always explain. Once you get the asset to the disposal account, you must never forget this. You must never forget this. We brought the original purchase cost. We brought the original purchase cost. But the value of that vehicle is not the value we bought it at. We have been using the vehicle. So we need to remove the accumulated depreciation from the date of purchase to the date of disposal. From the date of purchase to the date of disposal, so that you're able to know what is the net book value of the asset. What is the actual value of the asset? And if you now, this account helps you to do that in a big way. We are supposed to prepare the motor vehicle provision for depreciation, motor vehicle disposal account. So we could actually see provision for depreciation here. Depreciation. And you're saying motor vehicle account. Now, something very important. If you look at, we use the asset account to help us handle these two accounts. If you look at 2012, we are able to compute depreciation expenses. Well, let me put it here. Depreciation expenses computation. In 2012, we are told, the question tells us, depreciation is charged on a straight line basis, on a pro rata basis. Pro rata means for every 1 month you are charging depreciation. For every month you are charging the depreciation. So these assets were purchased on different dates. So the assets which were purchased on the same date, you compute the depreciation together. So the ones we purchased on 1st of January, the ones which was purchased on 1st of January, had a value of 1,200, and our depreciation rate, it is 15%. Our depreciation 15%, and we are using it for 12 out of 12 months. 12 out of 12 months. So 1,200 times 0.15 times 12. Definitely, you don't need to multiply by 12 over 12. So we get a figure of 180. And then, so that this motor vehicle was used through the year, so we get its own depreciation. And then there's a vehicle which was bought on 1st of July. 1st of July. So on 1st of July, we bought a motor vehicle for 800. So 800 times 15% times 6. It was bought on 1st of July, 6 months. We used it for only 6 months. 6 out of 12. So 800 times 0.15 times 0.5, that is half, we get 60. We get what? We get 60. And that becomes the depreciation for the first year, 2012. That becomes the depreciation expense for 2012. So we get this and we say this is 678, 180. So we come here and we say that the first of this, the year-end adjustment is done at the end of the year, 2012. And we are saying P&L, income and expenditure account, the profit or loss account, profit or loss account, we have 180. We have one what? We have 180. So we carry it down. We're saying we are debiting the income statement, so we are recording a depreciation expense account as we credit the provision account. As we credit the provision account, we are debiting. The corresponding account is income statement. So we debit profit or loss account with 180 as we credit the provision account. So we say that the 1st of December 2012, we say balance carried down. Balance carried down. So we come and say 1st of January 2013, we say balance brought down. Balance brought down is 180. Balance brought down is what?
180.
Balance brought down is 180. Balance brought down is 180. So if we want to get the depreciation now for the year 2013, we follow the same process. We follow the same process. We follow the same process. Follow the same process. 1,200 times 0.15 times. Yes. Sorry. This is 180. 1,500 times 1,200. 1,200 times 0.15. This is 180. This should be 180. This should be 180. So 180 plus 60, we get a figure of what? 240. So this one we say 240. We say 240. We say what?
40.
We say 240. We say 240. So we go to 2013. Again, we do the same. We do the same. I said you must be careful with the dates. You must be careful with what? Dates and the accounting policy. Our policy is for every month we are charging depreciation. So if we were to say now in 2013, we say the motor vehicles we had at the beginning of the year, we never sold any, so we still had them it was part of the closing balance. So we get it, this one, we are using it through the year. 2,000, so whatever we had in 1st of January, we are having 2,000 times 15%, times 12 months out of 12 months. We get 2,000, 1, 2, 3, times 0.15, 2,000, so that becomes 300. And then we have another one which we purchased on 1st of April. We purchased the 1st of April worth 900. So we come here and we say 1st of April, it is 900 times 15 out of, but we used it, we never used it for January, February, March. So we get 12 minus 3, you get 9, times 9 divided by 12. Times 9 divided by 12, 900 times 0.15 times 9 divided by 12, we get a figure of 101.25. 101.25. 101 point what? 101.25. Then we say the final one was bought on 30th of September. Was bought on 30th of September. So we only used it for October, November, December. We used it for only 3 months. So 1,000. So 1st of 30th of September. 30th of September, we bought an asset worth 1,000 times 15% times 3 divided by 12. 3 divided by 12, 1,123 times 0.15 times 3 divided by 12, we get a figure of 37.5. 37 point what? We get a figure of 37.5. We get a figure of 37.5, and therefore we add them up now. We add them up now to get the charge for 2013 plus 101.25 plus 300. We get a figure of 438.75. 438.7 what? 438.75. The charge for that year is 438. Is it 4 really? 3, 2, 1, 2, 3 times point, yeah, 1, 5. Yes, you get 438. You get 438.75. 438.75. 438.75. So we come, and at the end of the year, we say that 1st of December, we know our year here is 2013. So that 1st of December, we say P or L account, profit or loss account, we get 438.75. 438.75. 438.75. 1.54 or 1.25 plus 37.25. 438.75. So we add the two plus 240, we get a figure of 678.75. 678.75. 678.75. It is 2013. So we say that 1st of December, balance carried down. Balance carried what?
Down.
Down is 678.75. So on 1st of January 2014, 1st of January, we say balance brought down, it is 678. Point what? 75. We bring it down. We bring it down. We bring it down. We bring it down. 240 plus 438.75. It is 678.75. Good. Now. This is where you need to use your reason. This is where you need to use your what?
Reason.
Your reason. You need to be very good in reasoning here. So I would actually even want to do it closer here because of space. Depreciation accounting, depreciation expense for 2014. Listen to this. Listen to this. It looks very confusing. It looks very confusing. We had assets at the beginning. We acquired some and we disposed some. But if you follow the formula I'm going to give you, you will enjoy doing complicated depreciation accounting principles. When you come here, forget about what you bought. Forget about what you bought. First of all, start at what you had at the beginning of the year. What you had at the beginning of the year. Following the accounting policy. Our accounting policy is for every month that we are using the asset, we are depreciating it. Now, at the beginning of the year, we are told we had assets worth 2,900, but we disposed out of the 2,900. We disposed all these assets. We disposed all those assets. So you need to get the 2,900, remove the assets you disposed to get the value of the assets you had throughout the year. To get the value of the assets you used throughout the year. So assets used through the year. Assets used through the year. Through the year is equal to 2,900 minus 1,200 plus 800 plus 1,200. Now, once you get that figure, you will get the assets which we used throughout the whole year. Throughout, because this one we disposed in April, this one we disposed in June, this one we disposed in March, and our year ends on 31st of December. Our year ends on that 1st of December. So, once you get this, once you get the original purchase cost of all the vehicles you had at the beginning of the year, you subtract the vehicles you disposed. You will get the value of the vehicles you used through the year. And because the vehicles you used through the year, you multiply that by 15% to get their depreciation. You multiply that by 15% to get their depreciation. To get their depreciation. Let me do it. 1,200 plus 800 plus 1,200 plus 800 plus 800 plus 900 plus 900. We disposed 800, 900, and 1,200. 1,289. So we add all of them. We get 2009. $1,200 plus 800 plus 900. Something is amiss there. It cannot be. KBM 4413G. KBM 4413G was 1,200. KBM 6291 was 800. KBP 1540G. KBP 1540G. KBP 1540G. When did we acquire it? 1540G. It's 900. 900. So we are disposing it. It can't be, but the reason is, here when we were adding 2000 plus 900 plus 1000, this should be 39. This should have been 39. This is 2 plus 2 plus 1, 3,900. 2000 plus 1000, 3000 plus 900, that's 900. This should have been 3900. It should have been 3900. This should therefore have been 3900. It should have been 3900. So we now get 3900 here. We get 3900. Then we subtract 2900. 3900. We say this plus this plus this. This is 1700 plus 1200. That is 2900. 1200 plus 800 plus 900. We get 2900. 2900 minus 3900 minus 3900, we are left with 1000. 1000 times 0.15, we get 150. We get what?
50.
We get 150. Now, we have computed depreciation for the vehicles we had at the beginning of the year, and we used them throughout the year. But these vehicles that we disposed, we also used them. This one we used for 3 months, for 4 months, because we sold at that end of April. We used including April. We used it for 4 months. This one we used for 6 months, and this one we used it for that one for 9 months. We used it for 9 months. So these vehicles we need to compute their depreciation. And as we compute the depreciation of this, you must know that you are computing the depreciation for this vehicle. You are computing the depreciation for this vehicle, which we acquired on that 1st of March. So, so we compute their depreciation. We compute their what? Depreciation. Depreciation for vehicle sold on 30th of April. 30th of April. So we use it for January, February, March, April. So it is 15% of 1,200, but we use it for only 4 out of 12 months. We use it for 4 out of 12 what? 0.15 times 1,200 times 4 divided by 12, we get a figure of 60. We get a figure of what?
60.
We get a figure of 60. Then we get the depreciation for this vehicle. We get the depreciation for this vehicle, which was disposed. Which was disposed on that 30th of June. So KBM 6291, vehicle disposed. That 30th of June. And therefore, we say 15%. It was disposed on 30th of June, and therefore we use it for 6 months, January to June. 800%, 800 times 800 times 6 divided by 12. We get a figure of 0.15 of 800 times 6 divided by 12. We get a figure of 60. We get a figure of 60. Now, then KBP 1540, was disposed on 31st of March. Was disposed on 31st of what? March. So it was used for only January, February, March, 3 months. So we compute its depreciation. We compute depreciation. We say KBP 1540 depreciation. It is 15% of its original cost. We said it's 900. 900 times 3 over 12. We only use it for 3 months. You only use it for how many months?
3.
3.15 times 900 times 3 divided by 12. We get a figure of that 3.75. We get a figure of that 3 point what? That's the depreciation for that vehicle for those 3 months. That's 3.75. Now, all the vehicles we disposed We disposed KBM 4413G, KBM 4413G. We disposed KBM 6291. We disposed KBP 1540F. Those are the vehicles we did what? We disposed. So we have gotten their depreciation. The vehicles we used through the year and the vehicles we disposed. Then we acquired one more asset. We acquired one more what?
Asset.
One more asset. And we say that this new asset is called KCA. This one is KCA. This KCA 9450Y. 9450Y. KCA 9450Y. Now this asset, we say we acquired it through partial value of the KBP 1540F, which we valued at 800, and we also paid through bank. But this is a new vehicle. This is a new what?
Vehicle.
This is a new vehicle. And therefore, we need to compute its depreciation. The old vehicle we depreciated for 3 months, and the new vehicle, now we depreciated it for 9 months. We used this vehicle from March, so from April, we never used it for January to March, but we used it from April moving on. So we use this one for 9 months. We use it for 9 months. And therefore, KCA 9450, KCA 9450, KCA 9450Y. KCA 9450Y, we are saying it is 15% times 1,200 times 9 divided by what? By 12. We get a figure of 9450 0.15 of 1,200 times 9 divided by 12. We get a figure of 135. We get a figure of what?
135.
We get a figure of that 135, and that is the total depreciation for our assets in the year 2014. I want to repeat again. This area confuses students in a big way. This area confuses the students in a big way, but if you master my instructions, you will never be confused. You will never be confused. You must always remember, at the beginning of the year, we had assets valued 3,900,000, but out of the 3,900,000, we disposed of assets which were worth 2,900,000. So the vehicle we used for throughout the year is only 1,000. So that 1,000, we get 15%, we get 150. But the assets we disposed, we also used to them, and we charge depreciation for every month used. So you get the first asset, which is KBM 4413G, you get the first asset, and you get calculate its depreciation, 15% of 1,200, but we only use it for 4 months, times 4/12. Then you get the second one, KBM 6291 800, you get 800, 15%, but we only use it for 6 months. You get the third one. Here, you can even be more confused. But you must never forget, there is a vehicle we are disposing, so we used it for 3 months, and there is a vehicle we are getting, and this one we use it for 9 months. So the one we disposed, for the period we used it, you must compute its depreciation. 15% of 900. 15% of 900, but you only use it for 3 months, you times 3/12, you get at 3.75. Then the vehicle we bought, we used it for 9 months. We used it for 1 month because we never used it for January, February, and March. We use it from April. So you compute its depreciation, 15% of the whole value, 1.2 million, times 9 divided by 12 to get 135. So you add them up to get the total charge, plus that 3.75 plus 120, 60 plus 60 is 120, plus 150, we get a total figure of 438.75. 438 point what? Now that becomes the charge for the year. That becomes the charge for the what? For the year. So we come here and we say that the 1st of December, we say P or L account, 438.75. 438.7 what? 5. We add 678.75, 678.75, we get 111 7.5. Keep 1, 7.5. 1, 2, 3, 7.5. Keep 1, 7.5. You know, we are moving step by step. You are moving step by what? We are moving step by step. It's so easy. You move step by step. You move step by step. That is the depreciation that you charge in the course of the year. That's the depreciation that you charge because of the what?
Yeah.
But as we charge that depreciation, there are assets which we are removing. Once you remove it from the asset account to the market, you also need to remove its depreciation from the depreciation account to the market. And I always say to my students, the motor vehicle disposal account is like the market. So we need to never forget that. And therefore, we need to get the net book value. How do we get the net book value? We get the accumulated depreciation for each of these assets from the date of purchase to the date of disposal. We compute the accumulated depreciation from the date of purchase to the date of what?
Depreciation.
To the date of disposal. So, if we, for the three assets, we get the accumulated depreciation. We get the accumulated what?
Depreciation.
The accumulated, we just compute. We just do what?
Compute.
We just compute. And it is very simple if we have the policy. If we have the policy. If we have the what? The policy. Now we are told, here we are disposing KBM 4413G. KBM 4413 what? G. So, accumulated depreciation for disposed assets. For disposed what?
Assets.
For disposed assets. So this vehicle, we bought it on 1st of January 2012. We bought it on 1st of January when? 2012. And we used it that year in 2013, and we sold it on 30th of April 2014. So we need to compute its depreciation, which has been in the here and part of it here. So we need to remove it. We need to do what? We need to remove it. We charge depreciation here, 2012, we charge depreciation 2013, and we charge some part of the depreciation in 2014. So we need to remove that depreciation. We need to remove that what? Depreciation. So we say the original purchase cost was 1,200 times 15% times 12 out of 12 months times 2. For 2 years, we depreciate, at least we depreciate for 2 years. 2012 full year, 2013 full year. So we do that, 1,200 times 0.15 times 2 for 2 years, 360. For 2 years, 300 what? 60. That we have now completed the depreciation for 2012 and 2013. Now when it comes to 2014, it is partial depreciation. It is partial depreciation because we only use it for 4 months. We use it for 4 months. So we say this is for 2012 to 2013. Now 2014, we are saying the same, 1,200 times 15%, but times for 4 out of 12 months. 4 out of 12 months. 4 out of 12 months. So 0.15 of 1,200, we get a figure of 180, but you're only using it for 4 divided by 12 months. You're only using it for 4 divided by 12 months, so we get 60. So this gives us 360 plus 60, we get 420. We got for what?
20.
So we are saying, from the date this vehicle was purchased to the date it was sold, we had lost the value amount to 420. So as we remove it from the books of accounts, as we remove 1,200 here, we must also remove its depreciation from here to the market. We must remove its depreciation to the what? To the market. So here we say provision for depreciation. Provision for depreciation account. We are removing 420. We are removing 420. So we come to provision here. We say 31st of December 2014. We are saying asset motor vehicle disposal account. Motor vehicle disposal account, and the figure is 420. The figure is for what?
420.
420. So we are saying we are removing it. We are removing all the depreciation for this vehicle, which we charged in 2012, 2013, and even 2014. We are removing the whole of it, and because we are removing the asset, we also remove its depreciation. Because we are removing the asset, we also remove its depreciation, and we take it to the disposal account. We take it to the disposal what? Account. Now we are saying we bought the asset at 1,200 and the net book value is 420. Sorry, accumulated depreciation is 420. So we're saying the value of this asset is not the 1,200 which we bought. The value is now 780. It is 1,200, the original purchase cost, minus the loss in value of 420. We get a value of 780. We get a value of what? 780. But we are told that we are selling it at 900. We are selling it at 900. So when we sell it at 900, we debit bank and we credit disposal. We debit bank and we credit what? Disposal. We debit bank and we credit disposal. What are we saying? We are saying that this vehicle, which we now thought had a value of 780, 1,200 minus 420, we thought it had a value of 780 from our books, but we are getting 900. We are getting 900, meaning we are selling it at a gain of 120. This one is, we are selling it again of what? 120. We are selling it again of 120. Then we are through with that. Remember, because it is 1 year, we can put all the assets we are disposing in the motor vehicle disposal account, and we only take to the income statement the difference between overall the difference that we are going to get. So we now look at motor vehicle KBM 6291. Again, KBM 6291 was purchased on 1st of July. Was purchased on 1st of what? July. So we cannot compute its depreciation like KBM 4413. We cannot compute its depreciation like the other one. So we do it differently. We do it how?
Different.
We do it differently. We do it differently. We do it differently. We do it how?
Different.
We do it differently. We do it differently. We do it differently. So we are saying the other one, 6291, because this 6291, we purchased on 1st of July. And that's why it is very, very important to record the registration number of the vehicle and the date. I told you at the beginning, date is very important. So on 1st of July, so in 2012, we acquired the vehicle on 1st of July, and therefore we bought it at 800 times 15%, but only 6 out of 12 months. Only 6 out of 12 months. That is for depreciation for 2012. So 800 times 0.15 times 6 divided by 12, we get a figure of 60. Get a figure of
6.
Then we come to 2013. 2013, we know we used it the whole year, the whole of 2013, because we are selling it in 2014. So in 2013, it is 800 times 15% times 12 out of 12, 12 out of 12, we get a figure of 800 times 0.15, we get a figure of 120. Get a figure of what?
120.
Then we come to 2014. In 2014, KBM 6291, we sold it on the 30th of June. And therefore we use it for how many months? 6 months. We use it for 6 months. So we come and we say 800 times 15% times 6 divided by what? By 12. So 800 times 0.15 times 6 divided by 12, we get a figure of 60. Get a figure of what? 60, giving us a figure of 240. 240. Now we are saying, for this particular vehicle, we charge depreciation out of the 240. 60 was the depreciation of this vehicle, and this year, out of 438, 120 was depreciation for this vehicle, and this year, out of the 678, 60 was depreciation for this vehicle. So we accumulate all of it and we remove it. And we do what? We remove it. We come here and we say 240. And we are saying motor vehicle disposal account. Motor vehicle disposal. Please write in full in your account. Motor vehicle disposal account 240. So we come here and we say from provision for depreciation. Provision for depreciation, it is 240. It is how much?
240.
So we are saying we bought the vehicle at 800. We have lost value amounting to 240. We have lost value amounting to what?
240.
240. So 800 minus the loss in value of 240. According to us, the value of this vehicle is 560. Is 500 what?
60.
But we are told that we bought it. We were given 680. We are given what? 680. We are given 680. We are given 680. And therefore, we debited bank and we credit disposal. We debit bank and we credit what? Disposal. It had a value of 560. The net book value, this minus this, is 560. But we are receiving 560. We debit bank with 560. We credit disposal we debit bank with 680, we credit disposal with 680. Meaning, again, we are selling it at a gain. We are selling it at a gain. Let's look at the final vehicle. Let's look at the final vehicle, the motor vehicles account. I don't know what is this that we brought from motor vehicles account 800. Because the final vehicle, yes, is 900. This cannot be true. This cannot be true. We need to now compute the accumulated depreciation of KBP 1540. Ask yourself, when did you buy it? We bought it on 1st of April. We bought it on 1st of April 2013. We bought it on 1st of April 20 what? 2013. So we compute its accumulated depreciation in 2013. We compute its accumulated depreciation in 2013 and 2014. So we say in 2013, we bought it, KBP 1540. KBP 1540, we bought it on 1st of April, meaning we never used it January, February, March. We used it for 9 months. Used it for 9 what? 9 months. So 900 times 15 out of 100 times 9 divided by 12. We get a figure of 900 times 0.15 times 9 divided by 12. We get a figure of 101.25. And 1 point what? 25. Then in the KBP 1540 in 2014, we sold it on 31st of March. That 1st of March, meaning we had used it in the month of January, February, and March. We had used it for 3 months. So in 2014, we are saying it is 900 times 15% times 3 over 12. 3 over 12, 31st of March, 3 over 12. We say 900 times 0.15 times 3 divided by 12. We get a figure of that 3.75. That 3 point what? So we add the two plus 101.25. We get a figure of 135. We get a figure of 130 what? We get a figure of 135. 101.25 plus that 3.75. We get a figure of 135. And therefore, we come here and we say, we remove it again from provision. We remove it from provision, we say 135, and we are saying that the 1st of December, motor vehicle disposal account. Motor vehicle disposal what?
Okay.
Disposal account 135. So 135, and we are saying provision, depreciation, provision for depreciation. Provision for depreciation. Provision for what? Depreciation. Helping you. Please learn to subscribe, like, share, comment, and hit the notification bell, especially on this kind of a topic that confuses students over and over again. So we are bringing we are removing the depreciation from the accumulated depreciation account into the market, into the disposal, and therefore we are saying we bought the asset at 900. We bought it at 900. We have lost value of 135. We have lost value of 135. and therefore the value of this vehicle is 765. The value is 7 what?
65.
The value is 765, but we are told that we are getting a value of 800. It is valued at 800, and it is helping us to buy another vehicle with a value of 800. So we are saying we are getting from motor vehicle account. We are getting value on motor vehicle account amounting to 800. Amounting to 8 what? Amounting to 800. Amounting to 800. So we now close everything. We now close everything. We add the credit side because it appears to be bigger. 420 plus 900 plus 240 plus 680 plus 135 plus 800, we get a figure of 3175. Get a figure of 3175. The other side is 1200 plus 800 plus 900. We get a figure of 2900. So the total is 3175 minus 2900. We get a figure of 3175 minus 3175 minus 1200 minus 800 minus 900. We get a figure of 275. We get a figure of 2 for what? And we take it to P or L account. P or L account. We are basically saying that as we debit this, we are crediting the income statement. We are debiting the motor vehicle disposal account 275, and we are crediting the income statement with a gain on disposal. With a gain on disposal 275. When we debit the disposal account, it means we are crediting profit or loss account with 275. Anytime we credit the income statement, we are talking about an income. Anytime we are debiting it, it means it's an expense. So this is a gain. These are what?
Okay.
A gain. And that's what we're supposed to do. That's what we're supposed to do. Then we come here, 117, 1237.5 minus 420 minus 240 minus 135, we get a figure of 322.5. We get a figure of 322.5, and you see that the 1st of December, balance carried down. Balance. So what are we saying? We are saying when we go to our balance sheet, we will say our asset value, our closing asset is 1,200 minus accumulated depreciation of 322.5 to get the net book value of the asset. To get the net book value of the asset. Now, that's the way this question was supposed to be done. That's the way this question was supposed to be done. You need to be very careful when you deal with this. I want to repeat again, the rule is simple. The rule is simple. First of all, deal with what you had at the beginning of the year and what you disposed. What you had at the beginning of the year minus what you disposed gives you what you used through the year. Once you get that, the next step is get the depreciation for the assets you disposed. And the third step, get the depreciation of the assets you acquired in the course of the year. You will never miss it. You will never miss it. I pray that you'll never miss it in Jesus' name. I want to repeat again. The asset you had at the beginning of the year minus the asset you sold. Because these ones which you sold, you had them at the beginning of the year. You get the assets you used through the year. The ones you sold, because you used them in the course of the year, you also compute depreciation for the period that you used them. Then the assets you acquired in the course of the year, you compute the depreciation. Thank you very much once again. I want to urge you join our online classes. But even before joining our online classes, please like, share, hit the notification bell, subscribe, and comment. Tell us how we are doing, whether we are of help to you. Thank you very much. I really appreciate you viewing our videos.